Hot word in the market, recession. So lots to talk about it. Let's just get into it. I'm Julie Herman. If you have no idea who I am, I'm a local mortgage lender licensed in Washington and Idaho. I'm a certified mortgage advisor, and I'm here to help you take the fear out of real estate, learn about mortgages, and helpful insights to help you grow your business. Inflation is over 8% as measured by the Consumer Price Index. And while we may see it peak momentarily, we anticipate it to come back over the summer months. Inflation is the arch enemy to mortgage interest rates. Because the receiver of mortgage interest payments, this is the stock market where mortgage-backed securities are sold, they're just not making as much. Inflation makes everything more expensive, so there's less return. A lower return on the investment means there's less appetite on the stock market for investors to purchase, and that leads to increased interest rates for the consumer. The Feds are planning for several more rate hikes this year, plus we have their balance sheet runoff upcoming. And of course, we have the most hated word out there, recession. So remember, I said in 2021, there would be a recession in late 2022 or early 2023. Well, we're showing signs now. So what does all of this mean for housing? It's important first to understand that the Fed fund rate is critically tied to the U.S. economic outlook. It directly influences prevailing interest rates, such as prime rate, and affects what consumers are charged on credit cards, loans like a HELOC, just anything like that. But this is not your mortgage interest rate. And we get that confused quite often when we hear in the economy that your mortgage or that the Feds are rate hiking, and people think that that instantly means mortgage interest rates. So keep in mind, Fed rate is not mortgage interest rate. The Fed funds rate is the interest rate banks charge each other to lend Federal Reserve funds overnight. The nation's central bank uses it as addition to all their tools to promote economic stability, and they do that by raising and lowering the cost of borrowing. The Fed uses the Fed rates as a lever to grow the economy or to put the brakes on it. So example, if the economy is too slow, they lower Fed funds rate, which lowers interest rates and make it cheaper for businesses to borrow money, invest, and create jobs. Lower interest rates allow consumers to borrow and spend more, which helps spur our economy. On the other hand, if the economy is growing way too fast and inflation is heating up and out of control, the Feds might raise those interest rates to help slow down spending, and that helps businesses remain profitable while keeping people employed and keeping the economy moving, but at a slower pace. If we go all the way back to the 70s and 80s, Arthur Burns was the Fed chair. We watched inflation go from 7 to 14%. And like we already said, mortgage rates dislike inflation. It scares them. So mortgage interest rates responded by rising from 12 to 18%. Well, Volcker stepped in and increased the Fed rate. So that's column number 4. He increased the Fed rate from 11% to 20%, which helped inflation because they raised the Fed, which slowed down the economy. That helped inflation reduce from 14% all the way down to 5%. And that took mortgage interest rates from 18% right back to 12%. However, the consequence, anytime that you're slowing down the economies, people are spending less money, the consequence is going to be to the stock market. And we did hit a recession. The S&P went down 30%. Alan Greenspan, he saw inflation rise 2% in the 2000s, and mortgage rates were heading up. He raised the Fed funds from 4.75 to 6.5% just in 1 year alone. And we saw instantly mortgage interest rates slide all the way down to 5.5%. Hiking rates slowed the economy, and recession response, which is almost always unavoidable, it was negative, and mortgage interest rates went down. Our guy today, Jerome Powell, inflation currently has gone from 1.5% to 8.5%. This is the exact same pattern that we saw in the 80s, but at a very fast pace. He's been very aggressive already in Fed rate hikes, but we anticipate from the Feds up to 8 more rate hikes this year. They would like to see Fed rate hikes at least get to 3%, which will slow inflation. This is going to put us in a stock market recession, and mortgage interest rates will respond accordingly and come down. Here's a review from 2015 to 2018. So the Fed hike started to slow down the economy, and this is towards the end of 2015. They instantly did a Fed hike of 25 basis points, used that to slow down the economy. However, we had inflation creep back up. So we did another rate hike that helped a little bit. Then we did it 2 more times. Well, we had a runoff. So the runoff is when the expiration date's coming up on their mortgage-backed securities. Typically, they run off the balance sheet, they reinvest it back in, but this time they didn't reinvest it back into the mortgage-backed securities. So that caused inflation to shoot up very quickly, and mortgage interest rates went up as well. Following that steps was 3 more rate hikes to try to slow down the inflation. But it wasn't until Fed rate hike number 8, all the way here, that finally it took hold. That caused mortgage interest rates to come down, and the runoffs finally slowed down because their balance sheets were coming to an end, which caused mortgage interest rates to come down more, which caused inflation to come down. So what does it mean? It means don't panic. It's a good time now for mortgage rates to increase. That is going to help slow down the inflation on housing. It's not going to stop it. It's not going to bring housing back down, but it's just going to slow it down a little bit. So instead of the insanity of 20+% increases that we've been seeing, we are going to see homes still go over list price, just not at a crazy market that we were fighting with for this past 2 years. One of the very most reliable indicators for a recession is when unemployment rates reach their lowest level and start to rise. It's a large signal that we're going to have an upcoming recession. Unemployment rates tick up as Fed rates increase because, again, Fed rates going up affect businesses to help to slow down inflation. So that means that businesses are going to lose money on their profit and loss of their business. So whenever you have pressure on your profit and losses, you need to balance that, because you always need to have more profit than you have going out on a business. The easiest way to happen with that, unemployment, unfortunately. So we're going to see unemployment raise. This is why inflation just got so high. So during COVID, we did have an unemployment peak. The government was very terrified of people not spending money in the economy. This is why they literally gave out stimulus checks. Stimulus checks were meant to stimulate the economy, for the consumers to go out to the economy and spend money, even if they were on unemployment. So that way there still wasn't a massive hit to the economy, and that would help stimulate the economy. Well, we overdid it. So for example, the average family, the normal family during COVID, they received enough stimulus money to actually cover 38% of their monthly expenses, which was really helpful for the people that did lose their jobs. However, for the people that did not lose their jobs, this was an additional 38% of money that their family was not used to having. So what do you think they did? They spent the money. So Investopia reports, for qualifying individuals, the stimulus covered 38% of their monthly spending on average. For qualifying couples with one child, it covered 47% of their monthly expenses. And for those with 2 children, 48% on average. For single parents with 2 children, the stimulus covered just over 54% of their monthly expenses. Think about this. A lot more people are working from home. They're not driving, they're not commuting, they're not spending money out in driving, parking, things like that, that just come up with normal cost of vehicles. They could even downgrade, get rid of a vehicle. They don't have to have 2. They could reduce some of the insurance. Those are monthly savings. Those same families also maybe got rid of daycare as well. So they were affecting what they had to spend every month. And on top of that, they were getting 48 to 58 or 54% of their monthly expenses covered. That is really hard to go from that much cash freed up every month to normal living expenses that we're used to. That would exactly be losing half of your income. So that is going to negatively affect the economy. That is going to instantly start with people not spending as much money as they were in the economy, which hurts businesses, who again have a hit on their profit and loss, who have to lay off people in order to recover from that profit and loss issue. So what does that mean? When we get a recession, that's going to be bad, right? I mean, everything's just going to go to chaos. Well, first, as far as we're concerned, our mortgage rates, we have seen mortgage interest rates drop, and by quite a bit, after every recession. The last one that we had in 2020, it was by far the lowest interest rates that we've seen following the 2008 to 2010 recession. 1982 was our other biggest recession, and that's just declined. So if you look at these, every recession, which is in dark blue, following it, we have a drop in interest rates. So then recessions are really good for mortgage interest rates. That means it's got to be bad for housing, right? Because I mean, you can't have everything looking good. Well, if we look at the recession since 1960, shortly after the recession, housing prices increased. The only time that it did not happen was right here in 2008. And that's because 2008 was not a recession leading to a housing bubble crush. That was bad lending, housing crisis leading to a recession. So let me put it this way, because there's a lot of ways to look at how the housing crisis has happened. But this is the easiest way I can think of to explain it. Let's assume you have 100 friends. Not one of your friends have great credit, financially secure, fantastic income, low debt to income. They're a super great friend. You lend them money, they pay you back on time, everything's great. The other 99 friends that you have, well, they have bad credit, they don't have reliable paychecks, so they jump around between their jobs a lot, and they have fluctuation on their income consistently. They don't have any money saved up at all, but they still figure out how to go to Starbucks every single day and buy a drink. But you love them, so you lend all 99 of them hundreds of thousands of dollars. Heck, you let them buy something and you take some cash out of that purchase that they've made to help them pay for their own closing costs. So not only did you give them 100% of the money to buy a home, you've given them X amount of percentage of the home above and beyond that 100% to help them with their own cost to purchase that. But don't worry, they're going to be able to pay you back, right? Well, let's just assume they're okay for a bit, and half of them come back to you and ask you to borrow again so they can buy a second house. They did okay. They were kind of late a little bit, but you can understand why you're in the first house. So you lend them the money again, and now they have two homes underneath them. What do you think is going to happen? That's the reality. Not everyone that did or consumed a mortgage in 2007 was a bad loan, but a lot of it was bad lending. And we set people up to really fail. This is why nowadays mortgages are so strict. And it's frustrating when you're getting a mortgage, you feel like, God, why are you picking everything apart about me and making it so difficult to get a mortgage? Well, it's because of this. We don't want ever to be the cause of a housing crisis. We had so many bad loans out in the market with people that really did not have the ability to purchase a home, and they should not have gotten a mortgage. If we would have corrected the way that we did mortgages a long time ago, we would have never had a housing crisis in 2008. Let's look at inventory too. So that's going to be another key factor why this recession is not going to be like 2007, 2008. The housing market today is much stronger than any other time in history. There is not enough inventory, which is the complete opposite of the issue that we had in 2007. Look at how many houses were for sale in 2007. It's crazy. And even look at the 1980s. We had tons of inventory available to purchase. Tons of people were able to buy two homes and carry a note at the same time because their intent was to sell the other house, or their intent was to turn it into a rental. And they had lots of houses to choose from, so their houses sat on the market for quite a while. Nowadays, if you go to buy a second house, not only do you need to have enough money for the down payment, you need to be able to have a tighter or lower debt to income ratio. You're also going to be hit with a slightly higher interest rate, and you have to have 6 months, potentially 3 months, just depending on the loan program, of money set aside to cover mortgage payments on both houses, just in case That didn't used to exist. So we had lots of inventory. We had really, really laxed lending rules. Anyone and everybody could pretty much get a loan. We were setting it up to fail. But now we barely have any inventory available out there. Another cause of the supply issue is the number of households paired with the low inventory. We have a huge surplus of buyers out there looking to purchase, but there's just not enough homes. So, what do I think will happen? And this is just my insight. 2022, we're going to see a recession towards the end of the year, if not early 2023. During that time, the Feds will continue to try to put the brakes on inflation and mortgage interest rates will rise. I have no idea the exact number. I don't have a crystal ball. If I do, I would be guessing mortgage rates, not actually originating them. But I wouldn't be surprised if we actually see 7 to 8% in rates towards the fall. Home values will slow down. And when I say slow down, I don't mean negative. I don't mean come down. I just mean there's going to be a little less competition, which will soften how much over asking people are offering on a home. But the supply issue is still there. We have low inventory, high demand. And on top of that, we have 14 million more households today looking for a house than we did in 2007, with 3 million fewer homes. So when the recession does happen, interest rates are going to drop. We're going to be in a crazy seller's market again with extreme demand. And maybe I could be wrong, but I think it might even be worse than we saw during COVID, because we're going to have people that have the fear of missing out and they don't want to miss out on purchasing a home at a super low interest rate. The aftermath will be short-lived. Interest rates will drop for a short period. I think we're going to rebound to a safe 4 to 6% range, not too high, not too low, and housing prices will stall. So again, 2020, they're going to still keep going up because of inventory. When we see the recession and interest rates drop, I think houses are going to go up fast. Then I think they're just going to stall there. They're not going to come down. They're just going to stay like this. Honestly, the housing future looks really bright. So now is a great time to really help to educate consumers. And this is what I do every time I approve a buyer to go and look at homes. I don't have any buyers that are scared of this market because we go over this content. We talk about what the payment looks like, what worst case pricing could look like, and if they're comfortable with what that monthly payment will mean for their budget. The concept is that a house is an investment, and we're going to keep massaging that investment to make money for the consumer over years. The housing market, to me, looks very, very promising. Scan this code. Let's talk more one-on-one about your business. What is it that you need to focus on this year? How are you going to have an exceptional business model laid out? And how are you going to help to educate your consumers so that they truly understand what's happening in the market, what inflation and recession is going to mean, who should be making a change in their housing now at this point in time, who should wait? So I'm here to help support you, help educate you and our clients. So let's just talk about what is missing in your business model, and let's put a game plan together.